Okay, let's unpack this. You saw the headlines, right? A major tech company just reported earnings that didn't just meet expectations, they kind of blew them out of the water.
Yeah, pretty stunning numbers. And the drivers were, well, maybe not that surprising in retrospect.
Cloud computing, obviously, but also that term we hear everywhere now, AI.
Exactly. It's fascinating to see how that potential is really translating into hard financial results for, a company this massive. It's moving beyond just talk.
Right. And that's what we do here on the deep dive. We don't just skim the surface. We've got this detailed analysis of Microsoft's Q3 FY2025 earnings right here.
Mhm.
And our mission today is basically to pull apart these numbers, figure out what they really mean, not just for Microsoft, but, for the whole tech scene and what it signals for, well, for you listening.
It's a great window, actually.
Yeah.
This report gives us a lens to look at where tech is right now, the growth spots, and honestly, the sheer scale of investment going into what's next.
So let's dive in. We've broken this down into 5 chapters just to keep things organized.
Good plan.
First, an executive snapshot, the big picture. Then Chapter 2, results versus expectations, how they stacked up against the analysts.
Okay.
Chapter 3 is drivers and management highlights what pushed the growth and what the leadership team is saying.
Got it.
Then in Chapter 4, we'll look at the outlook and key metrics, segment performance, the nitty-gritty numbers. And finally, Chapter 5, we pull it all together with the bottom line takeaways.
Sounds comprehensive. And just a quick point before we start. Obviously, this is all for informational purposes. It's not financial advice or any kind of investment recommendation.
Good point.
And, when we talk about AI, it's based on these reports and current trends, not us predicting the future of tech or anything like that.
Absolutely. Important context. Okay, let's get into Chapter 1, Executive Snapshot. What's the top line story?
Well, the headlines really were about exceptionally strong Q3 results for their fiscal 25. Revenue hit just over $70.1 billion.
Wow.
And earnings per share, EPS, came in at $3.46. Both numbers significantly beat what analysts were generally expecting.
And the engine behind that beat.
Microsoft Cloud, no question. Especially Azure, which seems to be really catching the wave of businesses adopting AI.
So AI is genuinely driving Azure growth now.
Seems like it. The report links enterprise AI adoption directly to that Azure strength. But importantly, it wasn't just the cloud. All 3 main segments actually contributed positively to growth.
Okay, so broad strength. But this kind of growth, especially fueled by AI, usually means big spending somewhere, right?
Absolutely. And that's the other side of the coin here. Microsoft is pouring, and I mean pouring money into AI infrastructure, building out data centers, getting the hardware.
And that has consequences.
It does. We're seeing it hit the Microsoft Cloud gross margin percentage that's gone down. And their overall capital expenditures, or CapEx, are way up. It's a very deliberate strategy. Invest heavily now.
So it's like great results today, but they're spending big for tomorrow.
That's a perfect way to put it. It's balancing that robust current performance, thanks to cloud and AI momentum, with these pretty hefty near-term investments needed for, sustained future growth in AI.
And what was the vibe from management? Satya Nadella, Amy Hood?
Oh, very confident.
Yeah.
You definitely get a sense of, we know what we're doing, we're executing our strategy. Lots of talk about the transformative power of AI across their whole business.
Okay, so quick recap of the snapshot. Big Q3 beat, driven by cloud, Azure, and early AI wins. But they're also spending massively on AI infrastructure, which is squeezing cloud margins near term, but it's seen as vital for the future.
You got it. That sets the stage nicely.
All right, let's move to Chapter 2, results versus expectations. Let's get into those specific numbers.
Okay, so reported revenue was $70.066 billion,
Yep.
and diluted EPS $3.46.
And remind us what the street was thinking.
Well, the consensus estimates for revenue are generally in a range, let's say, roughly $68.4 billion up to maybe $69.6 billion.
So $70.1 billion is a clear beat there, quite substantial.
Very substantial, yeah.
Yeah.
Especially on revenue.
Mm-hmm.
For EPS, the estimates were maybe a bit wider, something like 320 to 348 maybe.
Mm-hmm.
Common figures were around, say, 321, 323.
So $3.46 is right near the top end, beating most of those forecasts too.
Exactly. The report calls it a substantial beat, and you can see why, particularly on that revenue line.
Okay, so they beat expectations. How does this compare to last year, Q3 FY24?
Really strong year-over-year growth. Revenue was up 13% as reported, that's GAAP. But if you look at constant currency, which smooths out exchange rate effects, it was up 15%.
And EPS.
Even better growth there, up 18% GAAP and 19% in constant currency. So, real underlying momentum in the business.
What about compared to the last quarter, Q2, sequentially?
Interesting comparison. Sequentially, revenue growth was actually quite modest, only up 0.7% from Q2's $69.6 billion.
Just a 0.7%, but EPS jumped much more, didn't it?
It did. That's the interesting part. EPS jumped 7.1% from $3.23 in Q2 up to that $3.46 in Q3.
So revenue barely budged quarter over quarter, but profit per share jumped over 7%. How does that work?
Well, the key seems to be cost control. The report highlights that their operating expenses only grew 2% year over year. That's much, much slower than the 13% revenue growth.
Operating leverage.
Exactly. When revenue grows faster than your operating costs, more of that revenue drops down to operating income, which is up a healthy 16% year over year. And that flows through to EPS.
So they're getting more efficient as they grow, basically. It's not just sales, it's managing the costs, too.
Precisely. It paints a picture of pretty disciplined execution alongside that top-line growth. We can maybe visualize it with a quick table summary. Metric Q3 FY25 reported Q3 FY25 consensus est. Range Q3 FY24 reported YoA growth. Got recorded Q2 FY25 reported QQ growth ranger. Revenue 70,066 cents. 68 $4 $69 to 6 pence. Beat 61,858 pounds plus 13% plus 15%. $69,632 plus 0.7%. Diluted EPS, $3.46, $3.26, $3.24, $3.48, beat $2.44 plus an 19 pound with $3.23 plus 7.1%.
Yeah, seeing it laid out like that really drives home the beat, especially revenue. Okay, let's move on. Chapter 3. Drivers and management highlights. What were Nadella and Hood emphasizing?
Well, the overall tone, as I said, was confident, optimistic. Satya Nadella really hammered home the innovation message, across their whole tech stack.
Right.
And a big part was about enabling customers to actually get returns on their AI investments, making AI practical, not just hype.
Did he call out specific AI services?
He did. Mentioned Azure AI, naturally, but also Microsoft 365 Copilot and GitHub Copilot specifically as examples seeing strong uptake and delivering value.
And Amy Hood, the CFO, what was her focus?
She hit on the financial strength, obviously, talked about disciplined execution, those strategic AI and cloud investments we mentioned, and also shareholder returns.
Yes, the returns. How much was that again?
$9.7 billion returned to shareholders just in Q3. That's through dividends and share buybacks, so pretty significant amount.
So the message is strong performance, investing smart for the future, and taking care of shareholders. Makes sense. Digging into the business drivers, what was the absolute main engine?
No question, Microsoft Cloud. Total cloud revenue, top $42.4 billion. That's up 20% year over year or 22% in constant currency. Huge numbers.
And within cloud, it's Azure leading the pack.
Absolutely. Azure growth was 33% year over year GAAP, 35% constant currency. Management explicitly said this was driven by both core cloud demand and, importantly, that AI demand ramping up.
35% constant currency growth on a base that large is, well, it's pretty remarkable.
It really is. But there were other contributors too, right?
Yes, definitely. They mentioned continued growth in Microsoft 365 subscriptions, both commercial and consumer sides, and also really strong performance in search and news advertising.
We'll dig into those segments more later. But even with all this good news, management did talk about challenges. Yeah.
They did. They were upfront about the fact that these huge investments in AI infrastructure are impacting the cloud gross margins. It costs a lot to build this stuff out.
Right, that margin pressure we keep mentioning.
And there was also a fascinating point about potential future bottlenecks.
Yes, that was really interesting. Management flagged potential AI capacity constraints emerging beyond the end of this fiscal year, so after June.
Wow. So demand might actually outstrip their ability to supply the AI processing power.
Potentially, yes. And that really frames why they're planning to spend over $80 billion in CapEx this fiscal year. They're racing to build out capacity to meet this incredible demand they're seeing.
So it really highlights that trade-off. Invest like crazy now, accept the margin hit, maybe even risk temporary bottlenecks, all to capture this massive long-term AI opportunity and stay ahead.
Exactly. It's a high-stakes game, but clearly one they believe they need to play aggressively.
Did the report mention the Q&A with analysts? Any specific topics?
It mentioned there was a Q&A with analysts from major firms, and likely topics included, data center strategy, AI capacity again, how much Azure growth is AI versus non-AI, scaling infrastructure, the economy. But our sources didn't have the detailed back and forth.
Okay, understood. That gives us a solid grasp of the drivers and the management perspective. Let's move to Chapter 4, Outlook and Key Metrics. Time to slice and dice by segment.
Right, so as we noted, broad-based growth. All three segments up year over year. Intelligent Cloud was just the fastest grower.
Let's start with productivity and business processes. That's Office, LinkedIn, Dynamics.
Okay, that segment brought in $29.9 billion in revenue. Solid growth, 10% gap, 13% constant currency.
And the driver within that, Office 365.
Yeah, Office 365 commercial revenue was up 11% gap, 14% constant currency. The cloud part of that grew even faster, 12% constant currency.
What's fueling that Office growth? More users, higher prices.
Both, really. Seat growth was up 7% year over year. They mentioned particular strength in SMB, small medium business, and frontline worker segments, and also growth in ARPU, average revenue per user. So existing users are maybe taking higher value plans.
So adding users and getting more revenue from each one, that's a good combination.
Definitely. And even traditional Office had some growth. On the consumer side of Office 365, revenue was up 10% gap, 12% constant currency.
How many consumer subscribers now?
They hit 87.7 million. That's up 9% year over year. Price increases help here too, though they noted some shift towards the cheaper basic plan.
Okay. What about LinkedIn?
LinkedIn revenue grew 7% gap, 8% constant currency. Still growing, but a more moderate pace compared to some other parts of Microsoft. Growth across all its business lines, though.
And Dynamics, the business applications part.
That was strong. Up 11% gap, 13% constant currency overall. But the cloud version, Dynamics 365, was the real star there, up 16% gap and an impressive 18% constant currency.
18%. So Dynamics 365 is really clicking. Okay, so productivity and business processes looks solid, consistent growth led by cloud. Now, the big one, Intelligent Cloud.
Yeah, the growth engine. $26.8 billion in revenue this quarter, up 21% JAP, 22% constant currency.
And the breakdown.
Server products and cloud services overall were up 22% JAP, 24% constant currency. But the headline, again, is Azure and other cloud services, up 33% gap, 35% constant currency.
That 35% CC number just jumps out, and you said it accelerated from Q2.
It did. It really shows that AI demand kicking in and pulling the whole company's growth rate up. But, as we keep saying,
it comes with that margin pressure. Right. Okay, last segment, more personal computing. Windows, Xbox, search.
This one had $13.4 billion in revenue. Growth was 6% JAP, 7% constant currency. A bit more mixed here.
How did Windows do? PC market stable.
Seems like it. Windows OEM revenue that's licenses sold with new PCs was up 3% year over year, both GAAP and constant currency.
Oh.
So yeah, and it gets a fairly stable PC market. No specifics on the commercial side of Windows or on service devices, unfortunately.
Okay. Gaming, Xbox.
Xbox content and services revenue was up 8% GAAP, 9% constant currency. The report noted this growth is kind of moderating now, probably settling down after the big boost from the Activision Blizzard deal closing.
Makes sense. And search advertising, that was surprisingly strong, wasn't it?
It really was. Excluding TAC traffic acquisition costs, search and news advertising revenue was up a huge 21% GAAP and 23% constant currency.
23% CC. What's driving that? Is it the AI and Bing and Edge paying off?
That seems the most likely explanation, yeah. Integrating AI features might be attracting more users, more engagement, and therefore more ad revenue. It's quite a standout result.
Okay, let's quickly recap segment revenues, maybe. Segment Q3 FY2025 revenue, YoY growth, CC. Key drivers nodes. Productivity and business processes, 29.89 cents plus 10% plus 13% M365 COM. Cloud plus 15% CC. Dynamics 365 plus 18% CC. LinkedIn plus 8% CC. Intelligent Cloud 26.88 cents plus 21% plus 22% Azure plus 35% CC. Server products and cloud services plus 24% CIC. More personal computing, $13 for plus 6% plus 7%, search XTAC plus 23% CC, Xbox content and services plus 9% CC, Windows OEM plus 3% CC, total revenue $70.01 plus 13% plus 15% driven by Intelligent Cloud.
Good summary.
Yeah.
Now, let's pivot slightly to some specific key performance indicators, KPIs, that give more color.
Okay.
Total Microsoft Cloud revenue, combining relevant parts of different segments, was $42.4 billion, up 20% in each bracket, 22% CC.
We already hit the Azure growth, 33% in Q2, 31% QC. What about M365 commercial?
C growth was plus 7% YoY. Cloud revenue growth was 12% GAAP, 15% CC, showing that ARPU increase is definitely contributing.
Okay, LinkedIn.
More moderate growth, 7% YEPI, 8% CC.
Dynamics 365.
Strong. 16% YEP, 18% CC.
Xbox content and services.
Normalizing. 8% YEP, 9% CC.
And Search X Tech.
Exceptional. 21% YEPI, 23% CC.
And finally, M365 consumer subs.
Reach 87.7 million, up 9% YOY.
So boiling it down, Azure and Search are the high flyers right now. M365 commercial is solid, focused on ARPU. Dynamics 365 is punching above its weight. LinkedIn and gaming are steady. And the cloud margin decline is the cost of playing the AI game.
That's a great distillation of the key metrics.
All right, let's bring it home. Chapter 5, bottom line takeaways. Let's talk overall profitability and financial health.
Okay, so overall gross margin was 68.7%.
Yeah.
The absolute gross profit dollars grew nicely, up 11% year over year to $48.1 billion.
Right.
But we know this story with the cloud gross margin being lower at 69% because of AI spending.
Right, but interestingly, despite that cloud margin pressure, their overall operating margin and net margin actually improved year over year.
They did, yeah. Operating income hit $32.7 billion. That's up 16% as JAP, 19% CC. Operating margin was 45.7%, which is up from last year.
And net income?
$25.8 billion, up 18% JAP, 19% CC. That gives a net margin of 36.8%, also up year over year.
So how did they manage that margin expansion overall when the cloud margin was shrinking?
It comes back to that cost control we talked about earlier. Operating expenses only grew 2% year over year. That discipline in other areas more than offset the pressure from the cloud COGS, allowing overall profitability margins to improve.
Shows really effective management across the board then. What about cash flow and the balance sheet?
Very healthy operating cash flow, $37 billion. But then CapEx was huge, $21.4 billion. Slightly below what they expected internally due to timing, apparently, but still massive.
So free cash flow, OCF minus CapEx was?
Around $15.6 billion,
Yeah.
which, highlights that prioritization, investing for growth over maximizing immediate free cash flow right now.
And the balance sheet. Still rock solid.
Oh, yeah. Very strong. Ended the quarter with almost $80 billion in cash. Net cash position, after accounting for debt, is around $39.7 billion. And, as we mentioned, they returned $9.7 billion to shareholders in Q3.
Okay, strong financials. What about looking forward? Did they give guidance for Q4, the quarter ending in June?
They gave some specific guidance. For intelligent cloud revenue, they expect it to increase 20% to 22%, probably constant currency.
Still very strong growth expected there.
Yeah.
But the cloud margin?
Expected to decrease again sequentially. They guided to around 67% for Q4, so that investment impact continues.
And CapEx? Still going strong.
They said the growth rate of CapEx would moderate sequentially, but the overall spending level will stay very high. They're still on track for that $80 billion plus figure for the full fiscal year 25.
So the Q3 story basically continues into Q4. Strong cloud growth fueled by AI, but ongoing margin pressure from the necessary investments.
That's the takeaway, yes. They didn't give full company guidance, but the market reaction seemed positive, suggesting folks were okay with the results and this outlook. Management sounds confident they can keep growing the cloud, even with potential capacity issues, and they're clearly prioritizing long-term AI leadership over near-term margins.
How does this stack up against the competition? You mentioned Azure growth looked good compared to AWS and Google Cloud.
Yeah, that 33% gap, 35% CC growth for Azure in the quarter ending March looks significantly faster than AWS's projected 17-18% or Google Cloud's reported 28% for the same calendar period. It really does suggest Microsoft might be gaining share, potentially because of their AI offerings landing well.
Interesting. So it ties into those bigger trends.
Absolutely. It underlines the secular shift to cloud, obviously, but also this huge new wave driven by generative AI. And you see the whole industry reacting with massive data center buildouts. Microsoft's $80 bellers, Google mentioned 75 BDA plans, Amazon likely $100 B+, and everyone's feeling some margin pressure from it.
So looking at Microsoft specifically, what are the key risks we should keep in mind?
Well, number one is probably those potential AI capacity constraints actually biting. Then, continued margin pressure from these investments. Intense competition, always. The macro environment, if IT spending slows down.
Yeah.
And just execution risk. Can they really monetize AI effectively and build out these data centers smoothly?
Makes sense. And on the flip side, the opportunities.
Huge. AI leadership and monetization. They were already talking about a $13 billion AI run rate back in Q2. Continued cloud growth, obviously. Getting more ARPU out of that massive M365 base. Getting more market share. And then eventually, when the peak investment phase passes, potential for really significant operating leverage down the road.
Okay. So Summing up the bottom line, a really strong Q3, beat expectations, driven hard by cloud Azure and AI demand. They're investing massively in AI infra, hitting near-term cloud margins but setting up for the future, managing costs well elsewhere, though, and still returning cash to shareholders. Confident, but aware of potential capacity limits.
I think that captures it perfectly. A balancing act, but one they seem to be managing effectively right now.
Right. That wraps up our deep dive into Microsoft's Q3 FY2025 earnings.
So just to quickly recap the key things for you to take away. First, Microsoft's cloud business, fired up by AI, is clearly the main growth engine.
Second, the overall financial results were strong, beating what the analysts expected.
Third, those huge investments in AI infrastructure are happening now, impacting cloud profits in the short term, but it's all about positioning for the future.
And finally, they're managing to balance this growth and investment push while still, giving money back to shareholders.
Precisely.
And maybe one final thought to leave you with. Think about how these absolutely massive industry-wide investments in AI infrastructure, not just by Microsoft, but by all the big players, how will that fundamentally reshape, well, everything? What are the ripple effects going to be on businesses, on our daily lives, beyond just the software we use? What new possibilities and maybe new challenges are bubbling up from this huge AI build-out?
It's definitely something worth pondering. We'd encourage you to look at the original sources if you want even more detail and just keep exploring what these trends mean.
Yeah.
And hey, if you found this kind of detailed breakdown useful and you want more analysis like this on earnings and finance, definitely subscribe to the Stock Analytics AI YouTube channel.
Great suggestion. And just one last reminder. Everything we discussed today is purely for informational and educational purposes. It is definitely not financial or investment advice.
And our discussion about AI reflects the current information and trends from the sources, not crystal ball predictions about future tech breakthroughs.
Absolutely. Thanks for tuning in to The Deep Dive.